All right, a very good morning to everyone out there, wherever you are, whatever province, whatever city, whatever small town you may be in. A very big welcome to our webinar series, Webinar Wednesday. Of course, as we know, it's become one of the most successful webinar series globally now, attended by many thousands of business owners around the country and, of course, around the world. So we're truly grateful to have you back. And as we know, the format for those of you it's first time, you're going to be highly excited about what we're going to do this morning, and I have no doubt that you'll be back many more times. For our seasoned attendees, welcome back. Always good to have you on board, and we hope that this morning that we can pass some key insights that can make a difference to your business in the journey ahead. And of course, the Experian series continues, the How to Be Financially Fit campaign, which has changed the lives of many business owners and entrepreneurs who own and operate their own businesses, of course. And this morning is a hugely exciting topic, insightful, highly important, and of course powered by Experian. And thank you to Experian again. They're a big partner of the NSBC. They're a major supporter behind Small Business South Africa. So Experian, thank you again for allowing us and sponsoring and hosting this all-important discussion this morning. And today's topic is the value of a credit policy within the trade credit environment. And just before I welcome our guest speaker on board, we know the rules by now. If you don't, guys, if you lose us for whatever reason, technology sometimes prances at different times. We will be back. Don't leave us. Fortunately, we've been in a very good position that it hasn't happened as yet. But and then, of course, importantly also, because these discussions are so important that you will receive the replay afterwards, and so you can take your time and go through it again. And another key point, of course, is that stay with the flow. We're back many more times, and we're heading towards the festive season or the holiday season is not for everybody, because we do know that all our retail SMEs they're heading for a peak season, and of course for those of you who are going to take a break, I'm sure we will chat before then. Now is the time to ready yourself and your business, reflect on this year, and prepare for 2025, because before we know it, it's going to be upon us. And so here we go. Our guest this morning is Muhammad Akoojee, who is the Business Research Manager of Experian. He's going to give a very insightful talk. Muhammad, please join me on stage. Muhammad, really good to see you. Thank you for being part of this. We do know, as you spoke offline earlier.
Good morning, Mike. Good morning, and thanks for
Absolutely. And as we know, we had a quick chat offline earlier on the importance of a credit policy within the trade credit environment. And as I mentioned, Mohammed is going to take us through a very insightful discussion. So please, Mohammed, and of course, if you've got any questions, you can pop them in the chat. Or if many of you done over the past 2, 3, 4 years, you can, of course, send it to our team afterwards, and we will make sure that Mohammed receives these questions so we can, in our own time, get them back to you and get them answered to you. But also, please tell us where you're from. 04, they're replying to NSBC Northwest Ventersdorp. Welcome. Tell us where you're from. It's always nice to see Mohammed. It's been amazing. We have people from all over South Africa, and we've even had people from New York and Tokyo and Sydney, Australia. So, but of course, 99% of our attendees are from South Africa, all over the province. So,
well represented.
Absolutely, Mohammed.
I'm personally from Mpumalanga, from Nelspruit, so it would be good to see someone from that province. But if not, Gauteng has been my home for the good past 20 years as well. So
I know we have a very big calling from the Nelspruit area. So tell us where you're from. Come on, support Mohammed and tell us if you're from Nelspruit. But yeah, Mohammed, but I think it's time over to you. And I'm certainly looking forward to this. And thank you once again.
100%. Thanks for that, Mike. Just a bit of background, I think, before policy and some of the slides around it. Some context to my background. So I had a department at Experian, and we involved in, essentially assessing companies across a wide spectrum of industries, and essentially assessing them for credit worthiness and essentially the sustainability, right? And I think over the years, we've been able to build up a good level of IP and really understanding, what are the key behaviors of a healthy business versus some of the traits of companies that perhaps find themselves in a bit of trouble in a couple of years' time, right? So if I can just perhaps get through to my first slide, key behaviors of what is actually a healthy business. And I think for small to medium enterprises, much as the audience is on today, what are some of the, how can I say, benchmarks that you could follow to ensure that your company remains resilient despite any changes in the market, any market volatility, etc. So if I were to categorize what is a healthy business, I would sort of pen it down to 5 pillars. One being the market position, secondly, financial health, operational efficiency, HR effectiveness, and then last but not least, it would, and I suppose, talk to the theme of what we're speaking to about today, prudent trade credit management and having an effective credit policy in place. So if I were to unpack it, right, in terms of position, often we would find companies that have been and proven themselves to be healthy year in, year out, are those that have really been able to conduct market research before they actually enter a market, right? Really understand what competitive advantage are they going to bring to the market, and really gauge from prospective clients if that is actually a competitive advantage or not. So before they actually engage in the business, they would do proper market research to understand what are the barriers to entry. Is it a capital requirement? Is it an IP requirement? Is it a competence barriers to enter the market and play profitably within the market that they aim to operate within? The second pillar would be around financial health. Ultimately, we've seen companies that have proven themselves to be healthy over a period of time are those that have not only grown their revenue, but also they seem to have revenue growth from diversified streams. Right? So, for example, they won't only be selling apples, they've also got bananas, in simple terms, oranges as well. So it sort of revenue comes in from different markets. And then second sort of attribute of a healthy business, I would say, are those that those companies that are very deliberate with the costs that they incur and making time and effort to ensure that they're only incurring costs that create value. Often we find companies just really being lackadaisical with the costs that they incur, and essentially it's not driving a revenue line, and ultimately you end up finding that they would end up being unprofitable, and it's only a sort of a level of time where a company would be able. And then within financial health, I think the third pillar would be around debt, right? I know, like in times where we are right now, and perhaps more around the COVID time where income has been a problem, or obviously taking debt on at that point was the right thing to do to keep your company sustainable. But my call here is that really to take debt on responsibly, making sure that it's in the production of income, and essentially we've got a sort of a track record of when we're going to repay that debt, and it doesn't put us in a sort of a jeopardizing position. Financial health, I would say, you've got a healthy business are those that would really drive their capex decisions based on where they are in their business life cycle, right? So what I mean by that is that a newly established company, your sole purpose should be to grow your business and not to really grow your asset base. For example, you shouldn't be focusing on acquiring property in your first 1 to 5 years. Really focus on growing your client base instead. And when you focus on growing your client base, ultimately with that sort of snowball effect, you would then generate enough equity in 5 to 10 years time to then go and make, so instead of then renting your premises in 10 years time, you're then able to buy it. But it's really about understanding where you are in your life cycle and making decisions based on where you are. All right. Next pillar, in terms of what is a healthy business, I would say it talks really to operational efficiency. So these companies that are healthy, essentially are those that are able to deliver product and service low on the cost curve. They're also able to operate flexibly in terms of their operations and adapt to any changing market trends. For example, a company that has got machinery, they're able to produce bread. I know it might sound a bit odd, but I mean they're able to cater for any seasonality within a particular time of year. And then the second last pillar would be HR effectiveness. We find healthy companies and companies that have been resilient year in, year out, are those that have got a stable workforce. And the stability, we find it across operational management and at board level. We also find leadership within these companies are hands-on in the running of the business. And then, lastly, from an HR effectiveness, medium enterprises as well, is that it's important to really focus on the skills versus responsibility element, right? An entrepreneur might be really good at founding a business, but they might be falling short when it comes to running the business. So we find companies that have been able to identify, this talent, say, okay, you might be good at founding an entity, but when it comes to running an entity, we might get, X, Y, and Z persons involved to actually run the finances and run the operations, etc. And then lastly, from an HR effective to really embrace Gen AI as a technology, it gives them the scale, to really, sort of upscale the operations without incurring any significant labor costs as well. And then last but not least, Mike, in terms of the last pillar, and I think this sort of carries through in terms of our theme of this discussion, is around prudent trade credit management, right? So here we find, healthy companies are those that have got, a defined trade credit policy, which then allows them to issue trade credit to their debtor, expose them to any significant bad debt or slow payment. So in this way, they can grow their business without any fear that they are going to be overexposed in terms of onboarding any clients that are perhaps non-credit worthy. All right. So that sort of covers the first slide. If I were to move on to the next one. Okay. So I think just to take a step back, right, and really understand in terms of that last pillar of a credit policy credit. So I think in the most simplest terms, it's essentially where a supplier allows a buyer to purchase goods immediately and would only then expect payment in typically 30, 60, or 90 days time, right? And then if we talk to what are the benefits of trade credit, so you must understand as a company, right, forms. One is offering trade credit to your database. So, you've got your clients and you give them a product or service now, and then, you would only expect them to pay you in 30, 60, or 90 days time. But then also there's a secondary split in terms of, receiving trade credit from your supplier. So your supplier would give you some product right now, but you would only need to pay your supplier in about 30, 60, or 90 days time, right? In terms of the benefits, let's take it step by step, right? So, we'll focus first on the offering trade credit to your debtors and what are the benefits there. And then we'll have a look at the benefits of receiving trade credit from your suppliers, right? So, in sort of, I would say summarized terms, when we offer trade credit to our database, what are the benefits is that we would grow our revenue, right? We would instill a sense of customer loyalty. There's also an element of competitive advantage. And what do I mean by this is that, your customer might have an option to purchase product from two different people, either you or your competitor. So your competitor might be offering them only on a cash basis. So they've got an outlet proposition to say, look, I can give you product now and you'll only have to pay me in 30 days time. So like that, you are able to gain a competitive advantage in the market. And then lastly, it's market expansion, right? So if you've got a strategy with your company that, look, you want to grow into, for example, a neighboring country, Zimbabwe, or, further up into the DRC, and you feel, look, to enter that market, you've got to enter in a competitive manner. You can then, come up with a strategy to say, look, you'll onboard credit-worthy clients and offer them credit terms. And in that way, we can enter a market and penetrate new markets. That sort of, covers the offering trade credit to our database. And now if you look at the reverse side of the coin, in terms of the benefits of receiving trade credit from your suppliers, right? So if you yourself as a company are credit worthy, you would find, a host of your suppliers coming to you and saying, hey, you know what? we want to do business with you. So take our goods now, and you only need to pay us in 30 or 60 days time. So what are the benefits there? So now all of a sudden, instead of you having to make an initial payment, for example, of 100,000 Rand for stock, you receive that stock, your 100,000 Rand is still in your bank account. You can now use that cash to operationally fund your business, or you could use it to embark on any capital expenditure. For example, you need new fleet or within your setup. So you're able to use that cash for that purpose. And then thirdly, by sort of engaging with the supplier on a credit term basis, all of a sudden now you've got more increasing purchasing power, right? So you haven't used your own cash, but you put in a substantial order with the supplier. And because of this, they are now able to offer you a better sort of pricing on your purchase, because of now you're purchasing in bulk. So all of a sudden, your profitability looks a lot better, right? And then the next benefit, really sort of speaking to the previous point, there's that loyalty aspect as well. And then last but not least, I think business owners would be the best to come to terms with this. We find, the pricing of items are, unfortunately, you don't find the pricing really going down, right? It's always on the upward trend. So by, leveraging off trade credit from your suppliers, you can receive goods right now and only pay in 60 days time. In that time, there could be a price increase, but you've now purchased it at a lower price point. So obviously you are now realizing some benefit from a lower input cost. The benefits of trade credit. And I think in summary, if you were to look, what's the overriding benefit of offering trade credit to your database? It would be business development opportunity. And the overriding benefit of receiving trade credit from your supplier base would be essentially, the cash flow element and the pricing value element, right? So that sort of covers the benefits of trade credit. But, like anything in life, you've got the advantages as well as the disadvantage element as well. And on the slide, you see the risks, right? The risks of trade credit as well. So when we offer trade credit as a company to our database, what are the risks to look out for? So essentially, it would be the risk of bad debt. So you might give your debtor goods of 100,000 Rand and you expect them to pay in 30 days. But there was some magic that happened, your goods and your customer disappeared. So, it's a bad debt that you now need to incur, right? You might also be exposed to slow payment. So you give them 30 days to pay, but they only pay you in 6 the terms. And then also the administrative costs, right? I think we shouldn't shy away from the fact that when you offer trade credit, there's also an admin cost attached to it, because you need to obviously be aware of who you're dealing with, either by means of engaging with the credit bureau to use credit reporting, or sending out collection letters. So all of those administrative costs are items to bear in mind, right? And then in terms of the risks of receiving trade credit from your suppliers, so if you as a company don't pay your accounts with your suppliers on time, exposed to possible interest, late penalty fees, the rating of your company with bureaus like Experian could be negatively impacted. Your supplier, could go the route of a legal judgment against your company, which would be, obviously not in your best interest. And then, if there's no payment coming from you to your supplier, ultimately you would find the suppliers, cutting down on your purchases, and that could lead to some supply chain disruptions, right? So that covers the risks and benefits of trade credit. Okay. So I think informed from what we've just highlighted above, right, where you find, a lot of the risks, and I think just to bear in mind now the slides that we're moving forward on, and we're focusing specifically on trade credit in a sense that you as a business offering trade credit to your database, right? So informed from some of the risks, and if you recall, some of the risks is risk of bad debt, slow payment, admin costs. Now to mitigate those risks, as a company, it's prudent to have a defined and robust, essentially it's you want to call it a constitution, which documents your terms and conditions, and SOPs, it's standard operating procedures, governing how do you onboard a debtor, and also governing how do you sort of stipulate the course of action for collecting unpaid debts, essentially. So if we were to sort of unpack the credit policy, I would say it's sort of within 5 dimensions. Within a credit policy, you would find the first component, which is your credit terms and limits. So essentially, what is the approval matrix needed to set credit limits or set credit terms? Secondly, it would have credit assessment criteria. So your credit policy would also dictate how exactly are you going to assess your clients before you onboard them. All right. Thirdly, your credit policy would also define what your credit application needs to look like. And I mean, we'll go into the next slide in terms of what exactly this credit application looks like and what needs to be in there. But essentially, it's a front-end engagement document onboarded debtor with your credit policy terms and conditions, right? Third component of a well-defined credit policy, it would also speak about monitoring and collection procedures. Obviously, the one element is onboarding your client, and now the second element is getting the money out of them in terms of the product or service that they've purchased, right? And then the last component of what a credit policy entails would be the risk management component, right? So in the credit policy, you would then indicate the strategies that your company would follow to mitigate credit risk, either by using credit report offered by Experian, or you might find that using credit insurance would be a suitable option, or you could, as part of your credit policy, encourage your database to really come in and provide collateral or security, as part of as part of their engagement, right? So now that you've got a credit policy in place, what are the benefits of a credit policy, right? Essentially, if I can summarize it, there's 3 benefits of having a differentiation. Secondly, inclusivity, and then thirdly, ownership allocation. So when we talk to standardization, what are we speaking to? Essentially, all debtors are treated the same, right? So when we onboard a debtor, we're making sure that they all follow the same process of credit vetting. There's no favoritism, whether it's your cousin or your uncle or it's a third party that's going to be onboarded. And I suppose it takes out that element of favoritism, right? So they all follow the same standardized credit vetting process. Second benefit would be inclusivity. And I think a lot of companies is hustle and tussle between credit control and sales team, right? The sales team wants to onboard a client. The credit team wants to make sure the clients pay their accounts at 30 days or 60-day terms. So with the element of inclusivity, you're making sure that everyone is aligned on the decisions. Everyone is aligned on what the process is to onboard a client. All are aligned in terms of whose responsibility it is to onboard a client and whose responsibility it is to make sure that the cash comes in. And I think this essentially speaks to ownership allocation as well. Within a defined credit, people involved in onboarding a client, they are there, the KPIs are tied to onboarding, and the personnel that are responsible for cash collection, their KPIs are tied to cash collection. So each one knows their role and knows their responsibility as well, right? So that covers an overview of our credit policy. And then just to perhaps speak to a specific component of the credit policy, which is the credit application, right? We all from time to time would have filled in a credit app, but as a business owner, if you haven't already or you're in the process of setting up your own credit application, what are some of the pertinent sets of information that needs to be added to a credit app, right? I think if we can categorize it, it would be within 3 areas of focus: legal compliance, and the third element would be the T's and C's of sale. If we were to speak to the questionnaire information, really to make sure that we receive from our client base their statutory information, trade references, banking information, escalation matrix, which is important as well, just to make sure that when you want to call them to find out where's the payments, you've got contact information of who the account or the finance manager is, up to the financial director and owner of the business. So if you need to escalate your inquiry, you've got a detailed view on who to speak to. The second component, which is important in our landscape, is the legal compliance. And because you are processing personal information, it is important to get your legal team involved to draft up a proper compliance statement within your credit app to make sure that you are bringing to the debtor's attention that you are processing this set of information for the purposes specified, and you're obviously operating on the right side of the law, right? And then thirdly, in terms of the T's and C's within the credit application, what exactly would that look like? So we would specify the payment terms, specify interest and late fees, what does that entail, the delivery and shipping, who is responsible for any damages during transit. So I mean, it's really just and I think the nutshell here is really to make sure there's no gray areas, right? From point of sale to cash receipt, everyone is aware of who's responsible and who's at risk during their entire process. And I think having a defined credit application just sort of removes all of that ambiguity in a trade trade credit environment. So that covers the credit application. And I think the next slide that I'll move on to would be a slide that speaks to the when you are engaging with a client on trade credit terms, there's 3 time horizons that a company would be exposed to, right? Essentially, when you are onboarding a client, it would be the customer acquisition phase. You would then move on to the customer management phase, and then finally you would then move on to the accounts receivable management phase. Mike, if you can just confirm if my slide on this is showing up on your end.
Top left, I can see collection letters, point 2, adverse listing on credit bureau. Yep.
Okay.
Yeah.
Okay.
Showing.
Okay. Yeah, the wheel now, right? Customer acquisition, customer management, and then accounts receivable management. Mm-hmm. All right. So, I mean, essentially, in terms of a credit policy that we've now spoken about in length, the benefits of it, etc. How does a credit policy guide us through the trade credit journey across each of these elements, across customer acquisition, customer management, and then AR management as well? So, just to track back a bit, a defined credit policy is essentially your terms and conditions, your SOPs, right? So within the customer acquisition phase, the credit policy would really guide us to the terms and conditions of how do we onboard a client, and really to make sure that we're onboarding credit-worthy clients, right? And then within the customer management phase, it would be, the credit policy would provide guidelines for ongoing credit assessments. How often should we be doing annual reviews on our client base? Because one is to onboard the clients that we have on our book are and remain credit-worthy clients, and the credit policy would then guide us to say, look, on an annual basis, you need to request annual credit reports or conduct site visits. So there's sort of governance around that, right? The third element would be in terms of the accounts receivable management. How does a credit policy support this particular area of engagement? Essentially, the credit policy would then outline procedures for timely invoicing, making sure that there's defined periods for payment monitoring. So really setting the operating rhythm to ensure that cash collection comes in, adequately and on time, essentially, right? So I think the next sort of question would be, as Experian, how do we support a credit policy? Right, and I think as you've seen, a credit policy provides value across all 3 of the customer engagement levels. And as Experian, as a registered credit bureau, we are fortunate enough to have feeds from the likes of CIPC, from the courts, as well as from client-provided data. And what does this mean is that we're able to provide our clients with fresh feed of data, allowing them to make informed decisions about their newly onboarded client or existing client, so that they are able to determine the credit worthiness and make their decisions based on up to date and relevant credit information. And, if we were to speak to, as a business owner, and many of you are on this call, before you onboard a client, what are the typical steps that you need to follow as a business owner to make sure that you are onboarding a credit-worthy client. So this is, specifically within the customer acquisition phase, right? So I would really, say that, even before you issue out a credit app to a prospective client, what I found in the market, we should never underestimate the value of sending out the sales personnel or even the business owner yourself, going out and doing a site visit for this prospective client that they've shown interest in doing business with you. You can, number one, identify whether it's a bona fide counterparty. Number two, you can also realize whether, by now supplying this particular data of yours, you're not putting at risk any of your other clients that might be in the same vicinity. So it's just prudent, as well, to do that sort of a pre-onboarding site visit check, right? Secondly, once they pass that and they tick that box, application be submitted onto the client for them to complete, providing a lot more detailed information and allowing you to either approve the credit app or decline it. And I think running parallel to this process, as Experian, we provide a number of services that are, as a bureau, we are able to complement this credit onboarding process. We've got services such as digital onboarding, our BIQ, process, as well as research credit reports, which is, more in-depth type of credit assessments, where we are able to provide, the user with, the real nuts and bolts of who this prospective data is, right? So I think the next question would be really around, now we've onboarded a client, right? So, congrats on that, pat on the back. Now that we've onboarded them, what do we now need to do, right? So now it's right, and then eventually the accounts receivable phase, right? So within the customer management phase, what are we really speaking to? It speaks to about maintaining and nurturing their customer relationships. And how do we do this? By monitoring their data credit worthiness. We also need to on an ongoing basis, adjust the credit limits to make sure that, look, when they were onboarded, they qualified for R1 million. Now that they've really paid their accounts all on time, they've proven themselves, we are now able to adjust their credit limit to 1.5 to 2 million. And this then, gives that business development opportunity. And then thirdly, it also within this phase, as a company, you would be addressing, any disputes with your clients in a prompt and fair basis, because ultimately in business, there will always be, a bit of perspective, right? I mean, they've got a perspective of what they expected the product to look like, and when they received it, it wasn't X, it was Y. But in terms of the dispute resolution, this is where it needs to happen, and it needs to happen fairly. Within, again, running parallel to this process, as Experian within the space of customer management, we are able to BI alerts and research credit reports just to make sure that, when you are engaging in any of your, processes within customer management, you are able to rely on a reputable credit bureau to make sure you're making informed decisions about either maintaining credit with a particular debtor, increasing the credit exposure, or even if you find there is risk because of any possible BI alerts, you are now sort of reducing your credit exposure to a particular debtor, right? And then lastly, in terms of, the last phase, in terms of accounts receivable management. So as a business, what would you be doing in this phase? It's ultimately overseeing this timely and accurate invoicing, monitoring of outstanding debtors, following out on overdue accounts, and then also identifying the accounts receivable data to identify any trends that you are picking up. So for example, if you find that, look, in November, December, the payments are coming in a bit later, next year around, you can then say, look, let's try and mitigate this to encourage payments a bit earlier, or move around the credit terms around that time of the year, just to make sure that as a business, your cash flow is not impacted adversely, right? So that is to this particular process of AR management. As a credit bureau, as Experian, how can we complement some of your work in this area? As Experian, we offer services such as collection letters, as well as adverse listing opportunities on our credit bureau. So, these are type of mechanisms that can be used to make sure that, the processes within AR management are effective, and you are able to essentially realize your cash when you do expect to receive it. All right, so that covers that. If I were to move on to the next slide. Okay. So you would have picked up, in the previous slide that, research credit reports first customer management phases, right? So just to unpack, what is a credit or rather Experian research report and, what's the nuts and bolts of it, right? Essentially, and then I suppose I've got a bit of a bias here because this is my area of focus as well within Experian, is that, a research credit report, provides an in-depth credit assessment of your newly onboarded client or existing client. Within the research process, we follow a very robust credit assessment process where we look at a wide range of economic, industry risk, country risk, the business risk itself, reputational risk. We also then analyze the company's financial statements and sort of collate all of this information collectively and then provide a credit recommendation, once we've got all of our ducks in a row in terms of the various risk factors, right? And if I were to just unpack a bit and speak a bit more about the risk factors itself. So within our Experian credit research reporting process, as you would have picked up factors, right? And essentially, if I were to categorize it into 6 pillars, the items that we consider when we're assessing the risk of an entity, it would be economic risk, industry risk, country risk, business risk, reputational, and then financial risk, right? So you might be asking, you're assessing a company, why are you looking at the industry, economic, or country risk? So, often the case is, a company might be operating really well and ticking all of the boxes, but they're operating perhaps in an environment where, the country, they've got forex shortages, so you might not be able to receive your cash timelessly. And then also industry risk, right? So a company might be operating stress, which would ultimately, impact this particular data of yours as well. And then economic risk as well, just to understand the dynamic of that economy that this data is operating within, the GDP rates, the inflation, the interest rates. So how sort of resilient it is to sort of weather some of these storms, right? And then if I were to move on to the next slide, in terms of the business risk itself. And I think before I actually move on to the business risk, in terms of the industry risk on the previous slide, as Experian, we actually offer, and essentially what does this, sort of mean to us and what does it provide to us is that we categorize the entire SA economy into a number of sectors and we look at each sector's performance, if you would, right? So just sort of FYI for the audience, on the latest BDI that we've released, the Q2 2024 BDI, we have seen improvements across a number of industries where there has been, a bit of contention, really around would be the construction industry as well as the social and services sector as well. We've seen the electricity sector improve markedly, and obviously this relates to the elimination of load shedding. But on the construction end, we find there to be a bit of a stumbling block when it comes to the construction mafia, as well as a lack of direct investment within that sector, right? So that's just on a side note, if any of the delegates are within those sectors, for them to bear it in mind as well, right? Okay, so I've moved on now. Let me just get it correctly. Okay, so just you would pick up that on one of our major risk factors would be business risk, right? So just to unpack the business risk element, what are some of the business risk elements that we would typically see to, right? So it would really include an assessment of their business model, really unpacking the nuts and bolts of how a company generates its services and product end to end. We will be having a look at statutory indicators. So the CIPC status, is it an active company or is it a non-active company? Are there any judgments against the company or against the directors? What's the tax compliance status like? Are they up to date with their tax affairs? We would also then be having a look at relationship data, right? So really understanding, how does this particular data or data subject How is it paying its other suppliers? Integrate with the banks as well to obtain a bank code. If we've got consent for that. So, holistically, we're able to provide then quite a robust view end-to-end of a company's business risk, and essentially coupled with the other risk factors. When we reach a recommendation within a research credit report, I think for all intents and purposes, we've really considered a wide range of sustainability indicators to make ultimately an informed decision to say, yes, the company would be in operational existence in the next 12 months, or there is certain risks that we need to be aware of, right? Okay, so that covers the business risk. Okay, so now the next one, in terms of the value, right? So you would have picked up in one of the risk factors is that we analyze financial statements, and what's the value of analyzing a set of audited financial statements. So if I were to sit back and sort of contemplate on that, as a set of financial statements, the value that it brings to us as Experian is that it basically tells us and gives us a litmus test of where the company is in its existing state of affairs, right? So we would typically analyze the company's income statement, balance sheet, and then within balance sheet, we pay quite a bit of attention to the net working capital component, and then also cash flow. So I'll give you guys some insights. So for example, you've got a new client that comes on board, and they provide you with a set of their financial statements. What are some of the indicators that you as business owners need to look out for to really understand whether this particular company is sustainable, or there's some red flags that you need to look out for? So let's take it step by step, right? When you're looking at a set of the income statement of the company, essentially we need to look out for the profitability of the business. Has the revenue increased? That's a positive sign. Is the company able to meet its debt obligations? You have a look at the interest cover, another good sign. In terms of the balance sheet indicators, typically you would want to have a look at the fixed asset base of the company. A growing fixed asset base means that, this company is not aiming to really liquidate and go anywhere anytime soon. We have a look at the solvency. Does the total assets exceed the total liabilities? We would also have a look at how the company is funded, right? What's important is that, is it debt funded, which is a bit more risky, or is it equity funded, as the owners themselves put their life savings on the line to keep this business active? If so, that you're dealing with a company that's a bit more lower risk, and they should be sustainable for the foreseeable future. Next component would be net working capital, right? So under here, you would then interrogate the balance sheet a bit more, having a look at the current assets less current liabilities, and if that value is positive, to tell you that this company has got enough current resources to cover its current liabilities. So in essence, they've got spare liquidity to then pay their suppliers and newly onboarded suppliers as well. And then the fourth component, cash flow. And I think this is really the heartbeat of it, right? So what does a cash flow statement tell us? It's a storybook of a company, almost like the bank statement, right? So it's like a sort of a bank statement for the company, explaining the opening bank balance at the opening of the financial year versus the closing bank balance. If that number has increased or decreased, the cash flow statement would really tell us what's the reasons behind that, right? Typically, for a company that we look out for that's sustainable, you would find companies that are investing in PPE. That's a positive tick. Companies that are cash generative, so they themselves can generate their own cash flow. That's a positive. Yes, it's good for a business to pay out dividends. But if we find that a company is a bit more conservative with paying out dividends, we find them to be a bit more resilient. They focus more on equity growth than dividend distribution. Again, a positive sign as well. So that would cover the financial statement component. If I were to now move on in terms of the some of our services, and now sort of covering the portfolio services offered by Experian. So as a business owner, if you've got a large, not an individual view of your debtors, but you want a more of a broad-based view of who your debtor your entire portfolio looks like. As Experian, we offer a product called Portfolio, and essentially what does Portfolio tell us or speak to? Hopefully you can read into some of the information on the slide. But if not, I'll sort of give you the value add or the value proposition of this particular service. So in essence, this portfolio services summarizes your entire debtors book and aggregates the data. So it gives you a portfolio view over time. 2 years, it would then categorize overall risk rating of your debtors book, right? It would also categorize your debtor based on the risk category. So for example, if you've got 100 debtors and they're all low risk, you would find the green column being shot up and everything else would be low. And this would, eventually tell you to say, hey, you know what, I'm actually doing something good where it comes to my credit policy, right? I'm actually on point on onboarding clients that are credit worthy. I'm obviously things are ticking in the right direction. But all of a sudden, if you now review this portfolio dashboard of yours and you find that, hang on, in the high risk category, now all of a sudden you need to now take a step back. Let's relook at our credit policy. What decisions are we making when we are onboarding clients? Because obviously we are now operating at risk, right? So it's quite useful in a sense that it can give you a sort of a litmus test of where we are when it comes to our credit policy and if it is effective or not, right? The second value proposition of portfolio as a service is that we've got, for example, some clients that have got a number of divisions, right? For example, a division that sells furniture, and then you've got another division that sells electronics. So this portfolio service would then allow you as a business owner to really categorize your debtors book in terms of the different ledgers. And then all of a sudden, as a business owner, you are able to now really segment, your client base, and also, really, engage in a level of comparative analysis on your ledgers, right? If one of your ledger book is performing well, whereas the other is not performing too well, you can look at where the gaps are and then try and figure out ways on how to bridge those gaps. And then secondly, it would also, right? Overdue balances are highlighted by ledger, enables the implementation of ledger-specific collection strategies. So, some strategies that might be effective in ledger A, you might find a different approach being effective in ledger B. So there's no longer sort of a blanket approach to engagement with your clients. You are able to be specific and pinpoint the way that you need to integrate with certain sectors of your, of your ledger, right? And then if I were to move on to the next slide, in terms of the portfolio service, another value add of the service would be around the customer exposure view, right? Another value add, this portfolio services allows you to really identify any particular credit concentration risk. So all of a sudden, if you find a lot of your credit is only being issued out to company ABC, and if that company were to go down or liquidate, all of a sudden, as a business owner, you would be really, in a lot of trouble, right? But if you find a better spread of your credit risk, you know that you are able, you're in a bit more firmer footing, right? I mean, there's no extraordinary credit concentration risk. So a product like this highlights it in black and white to say, look, here's your risk, or if there's no risk on the, on your radar, right? And then in terms of the next slide, another useful, and I don't think you might be able to zoom into some of these indicators, but I'll sort of read out what's the value proposition of using filters on the portfolio service. In essence, in terms of this particular, because there's a tick box for which industry you want to segment it in terms of. So you can, for example, tick that you want to view all of your debtors in the agricultural sector, for example. So what does this do? Automatically, it would then provide you with a robust view to say, look, you've either got overexposure to a particular industry or you've got underexposure, right? So this then opens up the conversation around business development or, on the other hand, risk mitigation or risk management. And then I look ultimately, I mean, sort of using a service such as portfolio, it just creates, more credit control team as well as your sales team. So making sure that everyone is on the same page, we're all aware of where our risk lies. And if portfolio identifies that, look, all of our debtors are sitting in high risk, we need to then take a step back to say, look, something along the way we're not doing right in terms of our credit policy, because we shouldn't be onboarding clients that are only high risk, for example. So a really valuable tool, in terms of the service itself. Mike, if you've got any questions for me, happy to take them.
Yes, of course, Mohammed. Thank you for that. Certainly insightful. And I've got a kind of the closing three questions that I've got. Or would you like to continue first, or shall I go on to those closing questions, Mohammed?
Yeah, look, you can go for it, Mike.
All right, yeah. I think we've spent a lot of time talking about credit scores and reports, and it's important for our attendees this morning, and talking about improving one's credit score, as we all know, is extremely vital. Please remind us what the value is for our members, our SMEs, knowing both their personal as well as their business credit score.
100%. So I think before I get into the question of value, I think just as in terms of the audience to understand what drives, and I'll sort of speak to at a high level also what drives your personal score as well, right? In terms of the items that really drive your business score, it would fall into three main categories, right? One would be commercial public data, commercial research data, and then also your payment performance data. So what drives, for example, a risk of, in this case, what's it like 56? In terms of the commercial, public data, we would be considering items such as, are there any judgments on file against it? It's a negative, right? Are there any judgments against the directors on the board? If there are any judgments, large or small, it doesn't bode well, for your score. Again, on the flip side, if it is clear, a positive indicator. And then also, we would also look at the ratio of principals with failed businesses. If you find companies that are in liquidation, a number of companies under your director profile that's under liquidation, or business rescue, for example, I mean, that would then highlight as a risk in terms of the overall score, right? So how long has director been on the board? If we can demonstrate longevity on the board, a positive indicator. And then in terms of commercial research data, the age of a business, right? So I think it goes without saying, a company that has been in business for a number of years, in most likely would be in business for the next 12 months. A newly established company, that's where typically, companies need to, really, be prudent about, the inflows and outflows to make sure businesses on the line would bear testament to the fact that, really setting up a business, weathering the storms of the first 2 years, if you would, it's not an easy task. But once they can demonstrate longevity of the business, essentially that then also translates into a better score. And then also the number of employees within the company, a company that generates employment, you would find them to be, more attractive to improving their scoring. And then last but not least, from a company risk perspective and a company score perspective, we would have a look at the trade reference data, the trade reference aging, as well as any overdue percentages. So if, for example, you're owing your supplier base 100,000, it's sitting in 90 days, 180 days. Obviously, there's a bit of risk there, so it would then bear down on your personal, on your business credit risk, if I should rather say. And then if we were to talk to your personal business risk, what are some of the indicators, right? And although I focus more on the business side, but having done a bit of research in terms of what are those components that drive your personal score, the leading indicator would be your payment history. So if you're paying your accounts on time, your bond repayments on time, and then also utilization levels of your facilities, right? So for example, you've got a credit card facility of 100,000, but you're only using 10,000 Rand of that facility. That then would also bode well in your favor. Also the duration of your credit history, the longer the better, right? So like in terms of if you've got a credit card that you've been servicing and making prompt payments on for the past 10 years, it does bode well for you. And then the next component would be new credit, right? So just as encourages that do not go and apply for many lines of credit at the same time. So if, for example, you find that a consumer is applying for a credit card plus vehicle finance plus a mortgage, a bond, all at the same time, this is not perceived as as a good indicator from a bureau perspective. And then the last component would be the types of credit, right? So as a consumer, having a mix of long-term and short-term credit is more favorable. It does, in essence, you might ask why. From a credit bureau perspective, to really honor both long-term as well as short-term debt. Again, it gives an idea of longevity as well as short-term honoring factor. And then, Mike, to your question, and sorry for laboring on the mechanics behind the score, but in essence, what's the value of knowing your personal score as well as your company's score, right? And I think just as a case in point, when a financer or a supplier is looking at you to do business with you or with your business, they would to keep that in mind. In terms of the value of knowing your score, essentially it's about access to financing, right? So getting your foot in the door with picking up your hand to say, look, I've got a good score, and I'm able to now be on the field of opportunity for banks to approach me. And then also there's the better financing terms element, right? If you've got a higher and improved score, all of a sudden now you would then be exposed to a lower interest rate, for example, or better financing terms as well.
Okay.
And then also in terms of trade credit perspective, having a healthy credit score, you would also now have stronger relationships with credit providers from a trade credit perspective. And now because you're sitting with a lower score, you can also use that as a leveraging tactic to go to your supplier base and say, look, you've been giving me 100,000 Rand credit, but look at my Experian score. I'm sitting with a 72. I'm a low risk. Don't you think I qualify for 150,000? So it just makes that conversation a lot more palatable, and you're sort of more empowered from a negotiation perspective as well. And then also another value would be, the item around strategic planning, right? If you know that, look, in terms of your business horizon, to as a business, for example, grow by acquiring your own property, you've got enough equity now, you need a bit of debt funding. It just allows you then to progressively track your score to make sure that, look, in 2 years' time when I need to approach the bank, I've been tracking my score. I know exactly, look, I was a 56 now. My aim is a 70. Let me try and get there ASAP to make sure that in 2 years' time, I can go knocking on that door, and the interest rate that I'm going to get from the bank or the product that I might be getting from my supplier, would be in my favor. Your inquiry or your question, Mike, on the value of knowing your credit score.
And Muhammad, just 2 more questions. How can our SMEs get their personal and business credit report from Experian?
100%. Good question. And from a personal perspective, 2 avenues. One is to visit mycreditcheck.co.za, and then we've also got the Up platform, which is up.experian.co.za. And from there, they are able to not only get their credit scores, but there's also useful tools, specifically on the Up platform, where there's financial podcasts where that can help consumers with, for example, with their budgets, and effectively assist them with improving their scoring over time. On the business side, it is a bit more cumbersome because, and I suppose rightfully so, we want to make sure that we are issuing out a business credit report to the owner of the business. So there's a bit of due diligence that happens when it comes to the business credit report. But where a company would want their own business credit report, there is an option. It's to send an email on to Service Desk South Africa, and from here you are then you put in your requirements that, look, you are this director and you're looking for your credit report on XYZ PTY. As Experian, we do a mini customer due diligence to have a look at your turnover. If it is less than R1 million, we are able to then issue you out the report at no cost. If it is above R1 million, I think there is a marginal price to pay for your own business credit report. So those are the two avenues, Mike.
Thank you. And Mohammed, my final question for you, and important one as always, who can one speak to discuss their personal and business credit report with at Experian?
100%. So I would direct them really, Mike, to the same channels. For the consumer credit report, it's really the mycreditcheck.co.za. There's actually quite a intuitive bot or robot on the platform which they can engage with. It's quite interactive, giving them what is needed and directing them accordingly for their consumer credit reports. Now we do not have a bot of the business credit reports, so I would then direct them to the Service Desk South Africa to obtain their credit score, or rather their business credit report, and from there they can interrogate that report. And again, if they do find items on that business credit report that they don't agree with or it needs to be updated, there is a questionnaire available on the NSBC website as well that they then can complete, and there is an avenue then of getting that back to Experian so we can update your business credit profile with the most update and in-date information.
Great. Well, I think that's comprehensive, Mohammed, and I know it's insightful, stuff we don't get to know and difficult to get hold of, but you've certainly answered a lot of questions, and your insights are extremely invaluable. And to all our attendees out there, I certainly believe that it's been a worthwhile experience this morning, and I've gained enormous value this morning, Mohammed. So I'm truly grateful for that. And please, I'll say it one more time. You've got to get your personal credit report frequently, as well as your business credit report. And I often get that question: doesn't my credit score get affected if I check it often? No, it doesn't. You've got to keep on track with it. It's the foundation to your financial success, is knowing your personal credit score and your business credit score. So, Mohammed, I'm truly grateful to you and to Experian, the organization. What you're doing for SME South Africa is unbelievably amazing, and we've made a huge difference this year and last year and the previous year, and we have no doubt that our journey together will be a long and fruitful one, making many more differences to SME South Africa. So, Mohammed, thank you, and to all our attendees out there, thank you very much. Stay close to us. Exciting things are going to continue. Thank you very much, Mohammed. Truly grateful.
Thank you, Mike, and thank you all for listening. Take care.
Thank you.
Content. Subscribe to our channel, hit the notification bell, and like our posts.